I'm Judy Shaw for NYSE Floor Talk. Joining me today is Luke Oliver. Luke is the head of Index Investing Americas at DWS. Luke, thanks so much for joining me.
Thanks for having me.
Luke, what's happening in high yield and how have you seen that activity affect your X trackers?
Yeah, high yield is incredibly interesting right now, and it's one of our big focuses. And really, the little known, or should I say, the well known secret is that following periods of stress like this, in fact, the last two periods where high yield spreads were over 1,000 basis points as they were during this crisis, high yield actually outperformed stocks in the following 12 months, and that paradigm has actually seen a lot of people catch on, a lot of people moving towards high yield in this period, and also seeing some interesting dynamics around some of the investment grade firms that drop down into high yield that are issuing debt, which actually has raised the quality of high yield a little bit as well. So some really interesting dynamics there, and we've certainly seen big flows into high yield.
DWS X Trackers was a first mover and leader in China A shares. What do you see in that space right now?
Well, A shares, which are the mainland Chinese stocks, are incredibly interesting also. And a lot of people have been underweight China for a long time. In fact, A shares structurally, because historically they were harder to get access to, are underweight in most benchmarks and therefore underweight in most portfolios. And I think a few people have this misconception that they dodged a bullet by not being in China during this period. And in fact, it's a big misconception because China has actually outperformed the A-share benchmark, has actually outperformed US stocks. And in fact, in all of 2019, the A-share market outperformed most major benchmarks also. So China has done exactly what it was supposed to do in this case. It offered great diversification, and the performance has been very strong as well. So from a forward-looking perspective, China still remains interesting. There's no doubt some risk there. There's probably going to be some action taken by the rest of the world in some way that will affect China as a result of everything that's going on right now. But at the same time, China's composition has changed. It's become much more of a consumption-based economy, which actually gives it the ability to weather those kind of storms. So very interesting, and the diversification benefits are fantastic.
Okay, now let's talk about ESG. We're seeing more activity in that space. You have various products in that space. Why are we seeing this activity?
Well, ESG has been a strong performer, and I think this is where ESG is really going to come out of its own and come out and actually really start to take off. And the reason I say that, not only have we seen the flows indicate that, but also the fact that the new generation of ESG products track very much like the benchmarks, but apply these ESG filters. And what we're seeing now is ESG is not just about the values. There is some potential here for risk mitigation. If ESG aren't just value-based metrics, they're really just non-financial metrics that we use to measure stocks that actually can have financial impact. And we've seen that through this period. So we've seen some modest outperformance of these benchmark tracking ESG funds. So one, these are low-cost funds. Two, they're benchmark tracking, which should give people comfort. And then there's that potential for risk and lower risk through the mitigation that ESG gives you, i.e. ESG arguably gives you companies that are better positioned for the future. And we're starting to see that in these turbulent times.
Okay, and finally, what role can currency hedging play in a portfolio?
Well, I think this is one of the least talked about dynamics going on in this very volatile period. We're seeing central banks easing, cutting rates. We saw Europe, Asia arguably had done everything they could already to ease and reduce rates. So seeing the US cut rates has really kind of put some interesting dynamics into play. And what I mean by that is usually cutting rates would weaken a currency and could be positive for stocks. But if the rates are being cut to counteract, falling stocks or the need to stimulate the economy, that itself creates a whole new layer of different factors. So, for example, as people are concerned, they go to a safe haven, you might see them buying into the US dollar to access treasuries. Now, that whole argument comes into play when we look at the fact that trade is down, oil is down, two of the big drivers behind the dollar historically. But then on the flip side to that, if we see the US market starting to outperform and recover and do well, we might see the risk on money flowing into dollars. So the way I look at it is we've seen currency volatility increase. We've seen correlations to their underlying stocks increase more positively, which is arguably makes those stocks more risky because you've got currency and stocks moving together in the same direction, good or bad. So being currency hedged can really take down your risk, especially in a volatile currency environment that we're in now.
Okay, Luke, thank you so much for joining me on NYSE Floor Talk.
Thanks, Judy.